Etienne, we can't hear you.
Sorry. Good afternoon. Is it working now? Good afternoon and welcome to this EPRS event on the 2022 World Development Report, Building and Financing a More Equitable Global Recovery. My name is Etienne Bassot. I'm Director at the Members Research Service at the EPRS. I'm here in Strasbourg with Vice President of the European Parliament, Mr. Karas, and as you know, the European Parliament is holding a session this week. I would like to welcome the panelists in Europe and in the US. Usually, EPRS event takes place at lunchtime, not during plenary meetings, but we wanted to allow the participation of our colleagues on the American side on the East Coast. At this policy roundtable, Leora KLAPPER of the World Bank will present the recently published 2022 World Development Report, which is about the post-COVID recovery. Grounded in research and real-world experience, the report highlights concrete steps that low and middle-income countries in particular can take to address the new risks they face and enable a more rapid and equitable recovery worldwide. The war Russia launched against Ukraine and the dramatic following consequences pose additional challenges, and I'm sure it will be also a ground for the discussion today. Leora will be joined by a panel of experts from the EIB, academia, and think tank community to discuss the multiple issues facing international policymakers. But before moving to the panel, I would like to ask our first Vice President, Othmar Karas, to share his thoughts. Mr. Karas is well known to all of us. He has been a member of the European Parliament since 1999. He is in the Bureau, which is the governing body of the Parliament, responsible inter alia for information and communication policy, the Members' Research Service and Library, which are both entities of the EPRS, and relation with NATO, OSCE, World Bank, and IMF. He's also a member of the Parliament's Committee on Economic and Monetary Affairs, and also the delegation for the relation with the United States. Previously, he has been also a member of the Austrian Parliament, and he was Secretary General of the Austrian People's Party. And I shall add also that he's a visiting lecturer at the Danube University camps, Vienna University for Economics and Business, as well as the University of Vienna. Since 1998, he has been president of the Austrian aid organization called Hilfswerk Österreich, and since 2009, founder and speaker of the non-partisan Citizens Forum, Bürgerforum Europa. Over to you, Vice President.
Okay, thank you. Thank you for the invitation and to organizing this event. I am pleased to open yet another joint event organized by the European Parliament, Parliamentary Research Service and the World Bank Group, our important partner. Such events as today make the strong ties between our institutions even stronger. They provide excellent reference and knowledge. They give valuable forecasts, analysis, and global overviews of the economic situation. They create awareness for the necessary and the right. I am particularly happy to have with us the author of this year's World Development Report and distinguished economists from think tanks and the European Investment Bank. You're warmly welcome. This report is the World Bank's flagship annual publication since 1978. It provides in-depth analysis of specific aspects of economic development. This year, it focuses on the financing of fair development to turn poorer communities into strong and vibrant ones. It is not the first time that we jointly hold such an event. Last year, the EPRS hosted a conference with Carmen Reinhardt, the Senior Vice President and Chief Economist of the World Bank. We are holding this discussion in gloomy times. Russia's war against Ukraine is killing thousands, including children and elderly people. Millions flee their homes. Cities are erased by inhuman bombing and shelling. We all know the pictures from the last weekend from Bucha. Our answer is bold and united. It must remain that way. New unprecedented sanctions against Russia and its allies. Full solidarity and support for Ukraine and its people. Drawing conclusions for the future of the European Union, including a common foreign security defense, migration, development, and energy policy. Democratic majority decision-making instead of blocking anonymity votes. Vetoes. Our fifth package of sanctions is on the way. Commission President Ursula von der Leyen proposed yesterday her draft with the 6 different pillars. The European Parliament will adopt yet another strong resolution tomorrow. The United Nations will probably suspend Russia from the UN Rights Council. And President Zelensky spoke yesterday in a video conference in the Security Council of the United Nations. Of course, our response has a price, and we must pay this price. Russia's aggression increases the economic difficulties caused already by the pandemic. It puts additional upward pressure on high inflation, and it creates an environment of stagflation, persistent inflation coupled with economic stagnation. We remember the similar economic situation of the 1970s. Skyrocketing prices of food and energy in the European Union, coupled food shortage in the Middle East and Africa. The World Development Report 2022 examines the central role of finance in the economic recovery from the pandemic. The pandemic triggered the largest global economic crisis in more than a century. Global poverty increased for the first time in a generation. The number of economic fragilities were elevated. The policy recommendations of the report remain valid and beneficial, even more after the war began, to further deprive the economy. This leads us to many open questions. What will be the result? A deeply divided world with 2 or more economic blocs? Will Russia team up with China to create a strong economic and political alliance? What will India do? At the moment, India as a democratic state is not supporting our sanctions. Will the current economic threats cause protest and instability in some emerging countries? In any case, financing fair development will be a key tool to help the world overcome its economic difficulties. It will and must be part of our comprehensive policy effort to revive peace and robust, sustainable and equitable growth. As the World Bank Group President David Malpass said, Making the right investments now is vital. Our response to the crisis today will shape our common future of years to come. We should seize the opportunity to lay the foundations for a durable, equitable, and sustainable global economy. In this spirit, ladies and gentlemen, dear friends, I wish you a fruitful discussion. Thank you for being with us. Thank you for your time. And thank you to share with us your experience. It is very important to think more about our future and the consequences of the present crisis. Thank you very much.
Thank you very much, Vice President, for setting the scene so effectively and highlighting how much these two crises represent major shifts for our economies and for the societies. Without further ado, I would like to hand over to Angelos Delivorias to chair and to moderate the session and introduce the speakers. Angelos is policy analyst in our economic policies unit and especially following the economic issues and monetary affairs. Over to you, Angelos.
Thank you very much, Etienne. And without further ado, let me welcome the first two participants from the World Bank. So as it has been said before, Leora KLAPPER is a lead economist in the finance and private sector research team of the Development Research Group at the World Bank. And she has authored this year, she's part of the group that authored this year's World Development Report. And she is joined by Rita Ramalho, who is a lead economist at the World Bank Chief Economist Office, and who will present us, to my understanding, the fifth chapter of the report, which focuses on sovereign debt management. I propose that you go ahead, ladies, and then afterwards I will present the rest of the participants. I will also remind the audience that they can type at any moment questions in the Q&A box on the right of the screen, and we will ask the participants at the end. Thank you very much.
Thank you, and thank you for the kind introduction, and thank you for the wonderful and sobering opening remarks. Okay, so thanks again for this opportunity to discuss the 2022 World Development Report, Finance for an Equitable Recovery, which we launched on February 15th. The report was drafted by an interdisciplinary team from the World Bank and IFC, and we hope that our report will elevate these issues, including the importance of healthy financial markets to fund government activities and humanitarian efforts, and the consequences of inaction among the government priorities during the recovery. So to summarize, our report focuses on the unprecedented financial and economic risks that have been created or worsened by the pandemic and the pandemic response, and outlines concrete steps that policymakers can take to address them. The major theme of the report is hidden debt, both sovereign and private, and that greater transparency and accountability of distressed debt is critical for an equitable recovery. The global public health crisis triggered by the pandemic quickly led to an economic crisis, which has increased global poverty and inequality. In 2020, economic activity contracted in 90% of countries. The world economy shrank by about 3%, and global poverty increased for the first time in a generation. And while the wealthiest 40% of the global population continue to recover, the income of the poorest adults is expected to continue to decline. And even as countries around the world were struggling to contain the spread of COVID-19 and manage the health costs of the pandemic, governments were quickly implementing and encompassing an unprecedented response, fiscal, monetary, and financial sector policies, all aimed at limiting the worst immediate economic impacts of the health crisis on households and businesses. And so we collected data showing that these included direct cash transfers, debt repayment moratorias, as well as central bank unconventional monetary policy, such as asset purchase programs to pump liquidity into the financial sector, which were used by 27 emerging markets for the very first time during the pandemic. In the midst of the crisis, these policy measures provided much needed liquidity support to households and helped avert a wave of loan defaults that could have threatened the stability of the financial sector. However, policymakers around the world now find themselves trying to achieve a balance between providing enough support to prevent the worst human costs of the crisis while limiting the longer-term risks, especially to debt and credit risk transparency that may result from the unprecedented crisis responses, like regulatory forbearance and delayed credit reporting, which can hide banks' true asset quality, and increases in sovereign debt, including hidden debt, to finance support programs. Our conceptual framework illustrates a central message of the report, that the numerous mutually reinforcing channels that connect the financial health of households, firms, financial institutions, and governments could trigger a global financial chain reaction. This means that elevated financial risks in one sector can spill over and destabilize the entire economy. To give some simple examples, inclusive access to financial services offers households and businesses financial resilience, economic shocks, and unanticipated expenses that many are experiencing, and allows firms to invest in the recovery. But banks confronting a decline in loan quality tend to tighten their lending. And we know from research that those reductions typically hit low-income households and small businesses the hardest, setting up a negative feedback loop between financial sector performance and real economic activity, the potential to increase income inequality. Official statistics seem to show that the private sector is in good health. Non-performing loans and bankruptcy rates are generally flat. But a lot of distressed and over-indebted assets remain hidden, thanks to all the forbearance policies that are put in place and are only now coming into view. And there's reason to be worried. For example, even before the pandemic began, wreaking havoc on the incomes of lower-income households and businesses, global household debt had increased by more than 30% as a share of GDP since 2008. And household balance sheet data showed that in low and middle-income countries, only half of all households had the liquidity to sustain basic consumption beyond 3 months. Business performance also seems to have been affected. I'm working with data from the MasterCard Economic Institute that tells a contradictory story. Globally, business failure rates doubled in 2020 above the 2019 and 18 baseline. These dynamics were already underway before Russia invaded Ukraine in early March. The economic consequences of the conflict are likely to exacerbate an already vulnerable situation. For example, Central Asian banks are highly exposed to Russia, and the Kazakhstan economy has fallen by over 20% since the war began. Furthermore, Russia and Ukraine together account for about a quarter of globally traded wheat, and disruptions to wheat exports could put further pressure on rising food prices, which disproportionately hurt the smaller wallets of poor households. Loan defaults can now sharply increase, and private debts can quickly become public debt as governments are forced into bailouts. Households and firms suffering from lower income and revenue also pay less in taxes. In addition, when the financial position of the public sector deteriorates from higher debt and debt servicing, this may weaken the government's ability to support households and firms. We also discussed global risks, such as rising interest rates and inflation risk, which, as Augustine Carson has explained nicely in a speech last year on central banks and inequality, inflation is a regressive tax that disproportionately hits the most disadvantaged because the poor see their wages erode, but typically don't have inflation-resilient assets to hedge these risks. And therefore, the responsibility of central banks' macro stabilization role can help make a more equitable society. The policy challenges going forward will be to ensure sustainable debt burdens and uninterrupted access to formal credit, so that first, households and businesses, especially low-income households and small businesses, maintain access to financial services. And second, governments and financial institutions can support the recovery and provide adequate financing, including for investments in all the services government needs to support, such as education and health, and potentially humanitarian support going forward. Our report focuses on 4 priority areas and policy measures governments should take now to avoid major financial upheaval. First, increasing transparency, reducing the share of non-performing loans to ensure that banks can continue to lend. Second, ensure effective procedures to discard distressed debt, including out-of-court mediation and conciliation, which is especially beneficial to small businesses and individuals. Third, ensure continued access to credit. And fourth, manage sovereign debt sustainability. For example, first, the financial sector is often exposed to household and small business debt moratoria, regulatory forbearance, freezes in credit reporting, all introduced to prevent the wave of private loan defaults during the pandemic, have also reduced credit market transparency. And so opaqueness has complicated the tasks of lenders, distinguishing between viable businesses with temporary liquidity problems and non-viable borrowers. For example, as shown here, more than 40% of surveyed businesses on average expected to be in arrears to both banks, also to suppliers, to government within 6 months, including over 60% of businesses in Turkey. Our first recommended policy priority is that the lack of non-performing loan transparency must be dealt with quickly, including improving loan quality, transparency, and encouraging banks to adapt their methodologies to assess borrower viability during the recovery. Or rising NPLs could lead to reductions in lending and investment. Without swift policy responses to hidden loan distress, we could also see an increase in evergreening, the continuing rolling over of zombie loans to businesses that are weak, with little or no chance of returning to health, and politicized government interference in debt resolution. Delayed action can cut off access to credit, destroy jobs, and discourage entrepreneurship. Authorities should also deal quickly with troubled banks, while always prioritizing and exhausting private sector-led and funded solutions. For example, a study of debt relief in India in the wake of the global financial crisis found a subsequent increase in strategic non-payment and default by borrowers and a decrease in new lending to the sectors that were bailed out. And for example, following the global financial crisis, Serbia's ration of NPLs was over 15%. The government took measures to improve bank capacity to deal with NPLs and improved and promoted out-of-court restructuring and in-court debt and mortgage resolution framework. Getting the framework in shape before COVID hit helped Serbia maintain low levels of NPLs through the pandemic. Second, many countries introduced fiscal support programs, including cash transfers for households or credit guarantee schemes for businesses, and need to ensure that the withdrawal of these stimulus doesn't generate a wave of loan defaults that could destabilize financial institutions and create contingent liabilities for their governments. There's a risk of zombie firms and politicized government interference in debt resolution. Ineffective insolvency regimes can reduce access to credit, especially for riskier firms and households, by reducing creditors' confidence that they can enforce their rights in the case of default. Delayed action can cut off access to credit, destroy jobs, and discourage entrepreneurship. Governments facing increases in distressed firms should prioritize strengthening formal insolvency framework. This is hard, especially during a crisis. But out-of-court options, including conciliation and mediation, provide more accessible and often affordable procedures, especially for SMEs. And history shows that insolvency reforms that encourage out-of-court debt workouts can be effective at bringing down non-performing loan rates. Efficient liquidation procedures can facilitate the market exit of zombie firms, especially in countries with higher state ownership, and a hybrid out-of-court arrangements that reduce the extent of court involvement in restructuring can ease the burden on overcrowded courts and reduce costs, especially for small businesses. Developing countries can look at the historical experience of Poland, far back as the early 1990s, when the state-owned national bank was split into commercial banks, which revealed high levels of NPLs in the bank's portfolios. Primarily conciliation agreements with debtors, the creation of a secondary market for NPLs supported the restructuring process and helped banks slash NPL rates. We also discussed how the real sector shocked to retail, food and entertainment, tourism, and other sectors, and the unprecedented policy measures, like credit reporting delays, in many countries have impaired lender visibility and made credit risk harder to assess. As a result, many lenders have tightened their standards. For instance, as shown here, central bank surveys of bank loan officers in 38 developing and advanced countries suggest that lenders in up to 70% of countries are tightening their credit standards each quarter during 2020, and many maintain tight credit conditions through 2021. Lenders need to adopt new mechanisms to improve risk visibility. Adjustments to loan maturity, contextual finance, and innovations in technology can all help, such as real-time measures of economic activity collected through digital payments, e-commerce, and supply chains. And COVID might have facilitated and sped up this digital adoption. In many cases, technology also improves recourse in the case of non-repayment, for example, by enabling auto loan payments directly from buyers and customers. We also discussed the crucial and supportive role regulators, supervisors, and policymakers play in facilitating technology-enabled innovation, especially in credit decision-making, by updating regulatory rules and upgrading infrastructure while ensuring consumer protection. Policymakers might also continue to use partial credit guarantees selectively to motivate lenders to continue offering credit. So for example, we bring in the report data from Poland's credit bureau, which showed that although demand for consumer loans fell in the months following the outbreak of the pandemic, lenders reacted by significantly tightening credit conditions for consumer cash loans, lending to a significant reduction in loan approval rates. But for installment products, which typically offer more visibility to the lenders and often a recourse of auto payments from the borrowers, approval rates fell only slightly and rapidly returned to pre-crisis levels. We also discussed the importance of strong financial markets to accelerate the transformation towards a sustainable world economy. For example, regulators can incentivize green investments, such as mandating higher risk provisioning for loans to sectors engaged in non-sustainable activities, and can leverage capital markets to fund development and green goals. We also discuss, we bring examples of the role of capital markets and how the economic stress arising from the pandemic propelled the expansion of sovereign sustainable bond issuances. Although there's no conclusive cross-country patterns, some sovereign green and social bond issuances seem to have paved the way for similar debt issuances by the private sector. And now let me turn the virtual floor to my colleague, Rita Ramallo, lead economist in the Chief Economist's Office. Rita.
Thank you, Leora, and thank you to the EPRS for hosting this event. It's with great joy that we present the results from the WDR of this year, so the World Development Report 2022. So as it was said already at the introduction, I'll be focusing on what we call the Chapter 5, or that focuses on sovereign debt, and in particular, the elevated risks of sovereign debt. So based on all that Leora already mentioned, as an aftermath or still the ongoing pandemic, countries have faced a high increase in the levels of sovereign debt. So this comes for two reasons. First, as the economy contracted, was much harder to get tax revenues, so the revenues decreased, and that's what the graph on the left side highlights. So when you see 2022, government revenue decreased across the globe in all regions. And at the same time, you had increased expenses. So governments had increased expenses, both the health aspect, so to address the health crisis, but also many countries, as it was mentioned before, implemented very ambitious stimulus package that needed to be financed. And a lot of that was financed through government debt. So we see consistently an increase in government debt across all income levels, and in particular for the emerging markets, so that would be the middle income and low income countries, so the red, light blue, and gray lines. This has been a trend that has consistently been going up since the beginning of 2010, and it was exacerbated by the pandemic. So you're increasing that when you already have a relatively high level of debt. This also applied to high-income countries, but there you would see that the increase throughout 2010 was not as significant as for the other part of the world. And this comes now, even though the report does not focus on any of the impact of the Ukraine war, but we know that this picture is likely to become more complicated, because as inflation is rising, in part because it was rising already before, but also with higher food prices and energy prices, it's likely that governments start changing and increasing interest rates to address that inflation, making it harder to roll over sovereign debt. So it makes it much harder to actually then be able to finance again the debt as it matures. And in addition, many developing countries do have food subsidies or even energy subsidies. So that increase in prices of those items also creates an additional stress on their budget, where they need more financing needs. If we can go to the next slide, Leora, please. So here we look specifically at Europe and Central Asia. So this, of course, includes the EU27, but goes beyond that. So we see a similar picture, although the decrease in government revenue was not as significant as globally, but you still see the same pattern of increase in sovereign debt, and very similar when you divide also by the different income groups, and you see in the note which countries are in which classification. And if we can go to the next one, Leora, please. So what are the policy priorities? So this is the situation we're now with high levels of sovereign debt. What can it be done to address this problem? I think first and foremost is to acknowledge that this is an issue and that needs to be acted on. And then once you acknowledge that, yes, you have a level of that may not be sustainable. So once a country acknowledges that, and I think it's important to have in mind that what is the sustainable level of sovereign debt depends on your debt carrying capacity. So countries with better governance can actually, and better growth prospects can actually sustain much higher levels of that than others that tend to be more the low-income countries where the governance is a bigger issue. So they have poor governance, and therefore it's much harder for them to actually sustain high levels of sovereign debt. So what is the right level varies country by country, and what are their characteristics. So I think figuring out exactly, are you beyond what you can afford, basically, as a country? And then once you realize that, then depending on how close you are to being in debt distress on default, the different policies apply. So if you're in fact really already in debt distress, what you need is to restructure your debt and actually get some level of that relief, or negotiate some level of that relief. Then if you're at a high level of that distress but not yet there, maybe the market can help you in finding new ways to refinance your debt. And we have a couple of examples of that in the next few slides. I think another area that is important for all countries, not just those that can be at high risk of debt distress, is improved transparency. So like any financial market, the sovereign debt market lives and dies on the level of transparency and information on the market. So if there is any level of opaqueness, then investors, financiers are less likely to buy the debt of that country. So there is that is crucial for having relatively good terms on your debt contracts. Contractual innovations are also important aspects that can help prevent problems and coordinate problems in case of unsustainable debt. And finally, more in the medium to long term, the way to solve that is actually to be able to increase your revenues and to be very wise in your investment. So you need to have the fiscal side also be up to speed in order to sustain your debt and be able to repay it. The next slide, please. So the next three, so this slide actually, before we go to the final three ones, this one actually focuses on the point of the need to address the problem sooner rather than later, and to actually do a restructuring that it's meaningful. So basically the chart on the right side shows you how long it took to resolve a debt restructuring for, several countries. We're highlighting in particular the countries from Europe, although many of them are not EU members. And you can see that, it can take 20, 30 years in some extreme cases. And the little vertical lines are how often you actually restructured your debt. So the horizontal line is how long you were in default. So in a way that you're considered as being in debt distress, you're in arrears, you're not meeting, or the government is not meeting their debt obligations. And the number of vertical lines is how often you actually reorganize. And you see there is a very strong correlation between how long it takes to resolve the problem and how often you reorganize. So oftentimes you're not reorganizing strongly enough, you're not restructuring the debt in a way that it makes it sustainable. So timing is of the essence when addressing elevated sovereign debt levels. And if we can go to the next one. So the next 3 slides are actually focusing on sub-Saharan African examples. So the reason why we selected sub-Saharan African examples is because more or less half of the continent is in high risk of debt distress or already in debt distress. So for that reason, we felt like it's important to highlight what policies were used in the past in this region and were successful in reducing the levels of that. So one of the very well-known policies was the HIPIC initiative. So that was for the highly indebted poor countries where there was a debt relief process, and this affected dozens of countries. This was something done in coordination with the Paris Club, the World Bank, and the IMF. And those at that point, because this was done in the early 2000s, most of the countries that were lending money to Africa tended, or to the world in large, tended to be Paris Club members, and then the World Bank and IMF, or regional development banks. So there were very few other players. Nowadays, there are many more other players in the sovereign debt market, including commercial ones too. So especially in this country, so making it much harder to reorganize and restructure that. But it was, so the case specifically of Rwanda, the HIPIC initiative was a success story because it actually allowed to free resources to invest in education, in health, so in more social aspects that could lead to a reduction in poverty. However, what we see now in Rwanda may be a better case than the average, but we see that across Africa, even though these countries had that level of that relief 10 years ago or more, they're now going back into high levels of debt because that relief is not a solution for that sustainability. You actually need to change your governance in order to be able to have a sustainable level of, to change sustainably your debt management. The next slide, please. Then here in the case of Benin, we just wanted to highlight how countries can use the market and what the market offers while interest rates don't increase too much to actually refinance their debt. So to be attentive to what the market can offer and see and be actively managing their debt so they can get longer maturities and lower interest rates, and even use things like Sustainable Development Goal bonds in order to be able to get better market conditions for their debt. And Benin was a very successful and entrepreneurial country in that aspect. And if we can move on to the next slide, which is my last slide. So as I mentioned before, one of the important aspects is transparency, and Mozambique is like the poster child of lack of transparency. So Mozambique had issued that not following their regular procedures, not following the approval of Parliament, and no one knew, other than the people directly involved in the contract, that there was this contract, which was then called the tuna bonds because it's related to a fishing company. And then once it actually is disclosed and becomes public, once I think it was the FT, the Financial Times, that identified this debt, then the country goes in a spiral, in a negative spiral, because now all of a sudden the debt that Mozambique has is much higher. So that's the red part in the graph. So the light red and the dark red was the part that was hidden. So all of a sudden now investors realize that this country has much more that they owe than they were owing before, and this debt is due, so that they weren't able to actually meet their payments, their debt service, and they went in default. And then this created a lot of distrust in the market. It was very hard for Mozambique to actually regain access to market. And Mozambique is still in the debt distress level, in disputing debt claims, but it created a big issue for the development of the country and prevented the access to credit markets for sovereign debt. And with that, that's my final slide. Thank you so much.
Yes, may I continue? I guess to wrap up, so just to wrap up, as Rita highlighted, the war happened at a time when global markets were already fragile, when sovereign debt was already high following the pandemic, which makes the situation more precarious. We're also not aware of any historical precedent to the globally widespread moratorias from domestic banks to their clients, forbearance on accounting for non-performing assets during the pandemic. The phasing out of these unprecedented policies amid efforts to foster economic recovery really has a societally new COVID-19 twist. But as we discussed in the report, the playbook for effectively detecting and dealing with hidden non-performing loans at the individual country level does indeed rely on past country experiences in dealing with financial stress. And so thank you again for the opportunity for us to present today. I hope you'll dig in yourselves to the report's finding, and sincere thanks to the discussants, and look forward to the conversation. Thank you.
Thank you both very much for this very interesting presentation. And I can only encourage everyone to read the report, which is very informative, written in accessible language, and with many, many examples. I enjoyed myself very much reading it. And let me now invite the other three participants to start the discussion. So we are joined today by Emily SINNOTT, who is head of Policy and Strategy Division in the Economics Department of the European Investment Bank. Professor Paola SUBACCHI, who is Professor of International Economics at the Global Policy Institute at Queen Mary University of London, and Adjunct Professor in Political and Social Sciences at the University of Bologna. And last but not least, Nicolas Véron, who is a Senior Fellow at the Peterson Institute for International Economics and Senior Fellow and co-founder of Bruegel, the Brussels-based economic think tank. So I welcome you all, and the floor is yours. Thank you very much.
Thank you very much, Angela. So I guess we'll just go consecutively and give, okay, perfect. So thanks a million for this presentation today. I think it's very opportune for us to look at this report and its findings, because I think, as pointed out, the Russian invasion of Ukraine has really been a sea change for the global economic environment, and it makes even more urgent the issues that are focused on in the World Development Report. And certainly in the EIB, we have growing concern on the uncertainty out there and the impact on our partners outside of Europe. So as pointed out, the situation was rather difficult coming out of COVID, both on the public and private side. And now things are, there's considerable uncertainty, but we're already seeing consensus forecasts have been revised downward considerably for 2022. But my kind of call today is that, we need to also look beyond what's just happening now and the initial impact of the crisis and what's happening in Ukraine. And our concern is that this may not just kind of derail the immediate recovery, but also could create some further obstacles for structural growth, so for growth in the future. And I think this is a very important point that Rita just made, that the secret to escaping these high debt traps or equilibriums is not just debt relief, etc., but also having sound economic growth and development, and that's key for poverty reduction. And so there are some issues that we're very concerned on that the current situation may exacerbate and actually dampen countries' growth prospects in the years ahead. And there, of course, like if we just go back, I mean, the 2022 World Development Report does highlight the difficult economic context prior to the war for emerging markets and developing countries, and the growing vulnerabilities. We share the concern there in the European Investment Bank, I mean, particularly on the issue of decelerating growth for many countries, how they would deal with the high inflation environment, the disruption of supply chains, as well as tourism, and the fact that the recovery has been a bit stop and go given COVID developments. The issue with how to deal with fading fiscal support, and of course we're concerned with that in the EU, but this is even more of an issue outside of the EU, and we don't have to go too far, but in some even neighboring countries, where the fiscal buffers that they have built up and the options for financing are much more constrained, are much lower than we would have within the European Union. And then record high levels of debt. particularly the sovereign debt, as pointed out in the World Development Report, make the situation very difficult and I think very concerning, particularly given the tightening of global financial conditions that we've seen in many areas. So, of course, the war is rapidly evolving and there are high levels of uncertainty, and in some respects we have a lot of questions that we still need to talk through and address and see how things evolve. What's going to happen to sanctions, what's going to happen in terms of oil and gas and Russian exports, and how will that impact the world economy? How will the sharp rise in commodity prices impact on countries, and how prolonged will that be? And particularly the impact on poverty that we've seen in previous episodes. How in this post-COVID environment can we prolong and ensure proper government support to ease poverty and, ensure that people can cover their daily basket of goods? Also, can we confidently say that COVID-19 is over? And I think this is a particular concern of us in the European Investment Bank. We've been investing a lot in vaccine development, but also just in the deployment of vaccines worldwide. And our call is that, the pandemic is not yet over, and certainly we don't have the level of coverage and vaccination campaigns that we have in Europe in many of the more vulnerable countries. But also, what is the impact of China's zero case policy, and what type of disruptions might we see from that in the future? So we're already seeing from emerging markets first signs of struggle in terms of the Ukraine war. We can bring examples there from Egypt and Turkey, but also look at the huge support that's needed for displaced people in neighboring countries such as Moldova. I'm just going to focus then on two areas in terms of the European Investment Bank where we're concerned to direct support in order to ensure that the growth impact of current developments is not prolonged and countries can come out of this and recover well. So first is on the private sector side. I mean, SME finance in emerging markets and developing countries is, for us, a big issue for focus. The data tells us that, a large share of firms and about almost 2/3 of formal private employment comes from these types of firms, and they account for a large share of GDP, about 40%. And these shares are even higher when we take into account informal SMEs. So they have a very important role to play in creating sufficient jobs for a growing global workforce. It was good to hear on the more positive banking developments in Poland, but we're hearing from our clients more signs of concern. So for example, every year we do this survey, Finance in Africa, where we survey the banks in Africa, and this year's is the 6th in the series. And this year they've really been highlighting, our clients, that the crisis has had a huge impact on the attractiveness of SME clients compared to larger firms for them. And they're concerned that they won't be able to provide SMEs with the support they need to get back on track. Similarly, even closer in the Eastern Partnership countries, we've just done a report where we actually did an enterprise survey, and what we find is that a large share of firms in need of a loan are still unable to obtain one. And their SMEs are particularly constrained. So access to finance it continues to be a very big worry there, and is stymieing innovation, recovery. And the issue is, once what support that there is being taken away by governments, given the uncertainty and difficult economic environment, we're worried in terms of what this may mean for SME activity. Additionally, on public investment, we've seen in the past that, as Rita pointed out, elevated levels of sovereign debt, which require fiscal consolidation. What we've seen in the past is that this has often resulted in a squeezing of public investment. And given the huge needs for digitalization and also for, on the climate side, and for investment, this is of concern for us, really setting the stage for longer term growth. And I mean, if we can just share some figures there, we did actually a climate risk index last year by country in 2021. We finished this. What we found is that low-income countries are more vulnerable to physical risk than any other group, in particular to acute events like rising sea level and excessive heat, but they have much lower ability to mitigate these challenges, you know, putting in place flood barriers, etc. And this was really the investment that we saw was crucial and was to be prioritized before the pandemic. And the concern is now, with this added uncertainty and difficulties due to the war in Ukraine, what this means for countries placed in these vulnerable positions. So with that, thank you very much. I think the report is really excellent and does a great job this year at a very important time of highlighting all these vulnerabilities. We really welcome this and the discussion. Thanks.
Thank you very much. Professor SUBACCHI?
Well, hello and good afternoon, and thank you very much for this presentation, the invitation to discuss the report, which I endorse Emily's view that is excellent and very rich with example and figures and data. Obviously, the report was written before the 24th of February, which actually changed significantly our world. As Emily said, obviously the situation now has been exacerbated. Without actually having made any coordinated action with Rita, I will focus my comments on chapter 5 on the sovereign debt, which is also part of my work. So I will also bring some of the research to them with my colleague at the Queen Mary Policy Institute. We are developing. Yes, we know then the pandemic, which is still, I concur with other speakers, is still ongoing. So we are not in the happy situation where we can actually look back to what happened in 2020, 2021 and say, yes, we are in a post-COVID world. Actually, the pandemic is still with us. But we know then that the pandemic has contributed to push debt to new heights, and that's very well illustrated by your report. And this has exacerbated, in particular, the situation of many developing countries, and particularly jeopardizing both solvency and liquidity. And we saw throughout the last 2 years and that a number of countries announced their intention to seek debt restructuring. Again, to mention only a few: Argentina, Ecuador, Zambia, Lebanon, and so they all are countries where de facto the default is on their debt. There was also some good news, because we also saw some resilience already built in the system. So countries that were vulnerable in past crises have managed to become more resilient. And in particular, and I'm sure that is also something that emerged in your report, there's been a shift in that composition, more towards the local currency denominated debt, as opposed to foreign currency borrowing, which is obviously much more risky for particularly for developing countries. So we've seen also the crisis response mode, and I like to stress this because the DSA, the debt services suspension service initiative, then, and the common framework then that the G20 promoted are very much crisis responses action, and they were good, and they could have actually led to more action, but that's another story. What I like to focus here is the point we actually with my colleagues made in a number of papers, which is crisis prevention is best than crisis resolution. So the point is, again, the G20, as it always happens, responded to the debt crisis with crisis resolution measures, while again, we need to think what we need to do to prevent this crisis. And so as you say in your report, how do we think in terms of long-term solution to the debt problem? And again, we got plenty of examples of countries that managed their debt in much better way when they plan over the long term rather than finding themselves into the default. So here we talk about the ex ante and the ex ante and the ex post. What do we need to do in order to manage debt effectively, as opposed to be in a situation where debt is already explosive, countries are already on the verge of defaulting on their debt, and therefore anything needs to be done, whatever it takes, in order to backstop the situation. So it's very important to focus on this ex ante. And it strikes me that some of your recommendations are very much like, for example, improvements in transparency, contractual innovations, well-developed tax policy, and so on. These are all part of this basket of ex ante measures that should be encouraged, and countries should really learn to do it, to apply this before it becomes very difficult to manage their debt. And again, capacity building, particularly for low-income countries, is very important. So also the ability to borrow in a responsible way, and so again, training the relevant people to really have the technical skills to get into this borrowing in a sustainable way, I would say. So that is my first thing. So ex ante and ex post. The other point I would like to make, having read your report, and in particular chapter 5, is the difference between debt and fiscal space. What strikes me about your report is you really focus on when debt becomes explosive, or explosive now is the current word in many papers working on debt sustainability and fiscal space. So in other words, when is unmanageable? And your report suggests a number of options. One is debt restructuring, and also you highlight the difficulties, and partly because of the complexity of the creditors out there, as opposed to just 20 or 30 years ago. The other options is fiscal consolidation, but again, that is very constraining for countries that are already experiencing a number of problems. And the other one is the reduction of domestic currency denominated debt. These are all very viable options, but again, they occur at this precise time when the debt is become explosive. So in other words, I like to focus, and I like to probably, it would be good to see more emphasis and focus on those countries that are not yet into an explosive debt situation, but they are somehow struggling to manage the fiscal space. So they have they are struggling with a level of debt, but also they need to maintain the fiscal space, and they need to maintain the fiscal space in order to be able to respond effectively to future shocks, to current problems, but also to future shocks. And I'm thinking again, echoing what Emily just said, the environmental crisis, and the fact that they need to respond to environmental shocks, but also prepare with investment for the green transition. So my question, therefore, is how wide is a fiscal, well, how broad is a country's fiscal space, given the recent surge in public debt? And so I guess the answer is it depends, and depends on many circumstances that are very, very typical core to each country. So each country, at least in our research, we can run a model, see some common features, but then each country has its own story and its own sort of fiscal space and its own debt limit, and when they reach this debt limit. Why fiscal space is important? Because, as I said, is a way to ensure that there is fiscal capacity to implement exceptional measures of fiscal policy where they are necessary in response to shocks. And again, we have a number of definitions of the fiscal space. We use operationally, we can find it as a maximum amount of public debt relative to GDP that a country can sustain without defaulting on its financial commitment. And obviously this definition refers not only to the impact of economic and financial shocks on public debt dynamics, but also to its impact on the economic outlook. So again, debt has an impact on growth, as we know, and obviously the ability of governments to take corrective actions. So my final point is we have a tool, a standards tool to assess the sustainability of public debt, which is the debt sustainability analysis. It's a good tool. It probably needs to be improved. It needs more the capacity, the ability to get a more detailed analysis, but is also very helpful for country to as a signal mechanism to understand where they stand in this area. But again, congratulations on your report. Very, very interesting, and I strongly recommend reading it to learn about where we are in this financial sustainability, resilience, and obviously inclusiveness. Thank you.
Thank you very much, Professor. Mr. Veron?
Thank you very much for having me again, and thanks for the opportunity to comment on the report, which covers a lot of ground. I think there are really many examples that are illustrative of the diversity of situations and a lot of lessons there. I won't speak on so much on emerging market situations because this is not where I definitely don't have any comparative advantage there. I've looked at those issues more in the context of the European Union, together with Julia Anderson and Francesco Papadia. We published a study about a year ago on the early experience of credit support programs in major European economies, including France, Germany, Italy, Spain, and also the UK. And since then, I've been involved in some follow-up evaluation efforts, particularly in France. So it's a bit of a partial perspective, and I will comment more on the corporate funding side. So very complementary to what was just said about sovereign debt. Obviously, what dominates is the uncertainty, both in terms of the COVID-19 experience, which was pretty unique in many ways, and I think there are many aspects of it for which it's too early to have a clear sense of lessons learned and evaluation. I think, for example, moratoriums on corporate debt are a good example of that, and I think the report is commendably cautious in terms of stopping short of drawing definitive conclusions, because I think we will have a lot to learn from what has been done in terms of moratoriums and forbearance, beyond the actions I just mentioned of credit support, but also because there is this overlap between the COVID-19 crisis, which is a focus of the report, and what is happening now with the massive uncertainty created by the war in Ukraine, whose consequences, of course, go well beyond Ukraine and beyond Europe. So this is a difficult panel in a way, because we're in a cloud of uncertainty. There's a lot of firefighting going on. Firefighting means you have to delay some structural reforms, and I think here, of course, it is natural that the report would insist on long-term structural reforms, such as, for example, insolvency reform, but we know that these things are very difficult, take time, are very contentious politically, and cannot necessarily be done in the midst of a major period of turmoil. So I think this distinction between the short-term firefighting, and I think that's still largely where we're in right now, and the kind of post-crisis structural reform, taking into account lessons learned, and here insolvency reform very much comes to mind. This distinction is important in the context of discussing this report and more generally thinking about financial sector policies these days. One thing I want to emphasize, and without wanting to be too long, because I really want to enjoy the Q&A and conversation, is the importance of good bank capitalization. And this has particular salience at the time when the European Union is examining its final transposition of Basel III, transposition of the final elements of Basel III, what bank lobbyists have long called Basel IV. We've heard a lot of discourse on Basel III, saying that Basel III was too harsh, that it was unnecessarily high capital requirement given the lessons of the crisis, that this unnecessarily high capital requirements would cripple the recovery. What we've learned through the COVID-19 crisis, and again now with so far relatively orderly financial sector impact of the war in Ukraine, is that high capital matters. And Basel III, if anything, was the minimum that we needed, not an unnecessarily high maximum. And I think this lesson is really important for lawmakers right now, because we're hearing the exact same arguments from the exact same banks and their lobbyists, that the last chapter of Basel III is excessive, even as we have learned that the previous chapters were actually something very necessary, and if anything, that we should have transposed more completely in Europe, because you know, of course, that the European Union is materially non-compliant in the assessment of the Basel Committee. So those same banks, by the way, are telling us, oh, but the first elements of Basel III were good. It's just the last bits that are bad. But if you look at what they were saying, same people, same institutions, when the EU was in the process of adopting the first Basel III package, they were saying it would cripple the recovery, make the banking sector in Europe uncompetitive, open the door to foreign banks that would eat our lunch, etc., etc. So you get my point. I think the EU should transpose the last bits of Basel III. It should transpose them in a compliant way with the global standards as the EBA and the ECB have recommended, and not listen too much to a bunch of bank lobbyists, pardon my language, that have lost their credibility when you take the long view of that debate. Thank you.
Thank you very much. I would like again to thank all the speakers for the very interesting presentations, comments. I have so many notes. I don't know how to. I don't know where to catch it. It's a broad report. It broaches very different subjects. But most of them, all of them, are very important, as the participants said. Hopefully, and I want to stress that hopefully we will be here in 2-3 years saying, okay, thankfully nothing happened and the nightmare scenario did not materialize. But I think that many of those topics in the report, we will be discussing them in the next few years, because they are extremely important, and the situation economically, the economic situation globally is not getting any better. I would like to share the optimism of, I mean, not the optimism, the view of Mr. Véran with regards to capital markets and banks regulation. I think it was very important, the things, and possibly in the capital markets, not enough, the things that have been done. But I was surprised happily to see that, contrary to the global financial crisis, the European Union and most other major economies did not have major financial stability issues, despite the huge COVID impact, and also now the war in Ukraine. Of course, this is recorded, and I will probably, it will probably age very bad what I'm saying, but for the moment, things are good. I think that it would be interesting, possibly. Unfortunately, we did not have many questions. We did not have questions from the audience for the moment. I again encourage them to type them in the Q&A. But there are so many questions that were asked during the various interventions that I would like to pass the floor again to the various participants to discuss. As far as I'm concerned, I find it quite interesting, because we are discussing a report of the World Bank, which is on a global level, but many of those things have to do also with the EU. And in many of the publications that we have drafted as EPRS, we can find again the concerns about the SMEs, which are the backbone of the EU economy, as we find in numerous publications, and what is going to happen due to the COVID-19 pandemic, or the lack of investment as a result of consolidation, or the war in Ukraine. Again, the context of the twin transition, the digital and environmental transition that we are going through, and how are we going to prepare. In this context, we have the RRF, and we have, as EPRS focused a bit on this twin transition and the RRF in some of our publications. Again, the sovereign debt management and restructuring, it was good to see that over the last 6-7 years, since 2014, including Greece in that, in fact, we didn't have many defaults. We had sovereign debt restructurings that were using new CACs, that were using new technologies, that were using new this difference in approach, as you said, but we didn't have catastrophic situations. Now, I cross fingers for Argentina. It seems that they have secured also this new deal, and things are going well for the moment. So I think that there are reasons to be optimistic, not to stop midway. There are still many things to be done, and I would like to ask Emily SINNOTT, for example, and Rita Ramalho, sorry for mispronouncing the name earlier, by the way, for a part, and also Professor SUBACCHI for what is their, I mean, I wouldn't say assessment, but we have seen that the war in Ukraine now may deal an important blow in several countries. And do you think, it's not really well phrased, but do you think that that those countries are ready? Do you find countries that you would be more stressed with regards to how they will manage their debt? I saw in the report that there is already some focus in particular cases, but I don't know if, you know, with the new addition of the war in Ukraine, the increase in energy prices, the increase in wheat prices, especially in the Middle East, Egypt, some other countries, etc. Are you focusing your attention on particular countries or not? Mr. Véron, I would like again to ask, to thank and to ask also possibly with regards to, but that is a bit of a previous thing. I remember reading on the on a similar subject, but what is your point of view on what you have been proposing before, the concentration charges that you were proposing in previous elements with regards to sovereign debt? And also, if you have a particular opinion now on, because I saw that certain countries have been starting to implement, for example, GDP linked warrants and other things. Do you think, in fact, those are questions for everyone. Sorry. And I think that those are extremely important things that are happening and very interesting from numerous perspectives. And I will stop here. I will give again the floor to Rita Ramalho and Leora KLAPPER, and then to our three discussants. And thank you.
So I'm actually quite interested in the responses from the other panelists here. Excellent questions. I guess to add, really an underlying theme of the report are the micro implications of these macroeconomic stress, which is something that certainly regulators often don't pay enough attention to, right? So, as you mentioned, what are the implications of Ukraine and perhaps stress to banks in the European Union as a result of weaknesses, in Central Asia, in Latin America, and elsewhere. And specifically, again, there's a long research precedent that long research showing that when banks tighten, as a result of increases in non-performing loans, as a result of decreasing capitalization, it's the firms that are perceived as riskier, the smaller firms, which are hit the hardest. And so, as you suggest, certainly and similar to the economies overall, as wealthier adults continue to recover, as larger firms continue to grow, there is this impression that households and smaller businesses might not keep up with the recovery, especially if we see credit tightening to these sectors.
Thank you for your question. So on the sovereign debt issue and how the current situation in the global economy can make things worse or less worse, and which countries would be more affected. So I think more than saying specific countries, I think the important thing is thinking of countries' characteristics. So countries of different characteristics would be affected differently. And so, for instance, if it is an oil exporter, given that oil prices are going up, then maybe that might be easier for that country to deal with its debt. So one of the examples there would be Chad, which is a country which is now in debt distress, but maybe with high, depends on how long the high oil prices last, it may actually be easier for that country to deal with its debt. But by and large, because most countries are oil importers, are not producers, and even Chad is, food importers. So like the food prices are always affecting the great majority, especially of low-income countries, in a negative way. By and large, the shock would be one that would reduce the fiscal space and would, put more stress on governments' budgets. That is the general answer.
Hi, if I may come in. So I guess the countries that have been most affected directly, the neighboring countries to Ukraine, actually did start this unfortunate, terrible war situation in a better fiscal situation than many other economies. So there, countries, obviously you have the Estonias, Polands, etc., that have actually built up a lot of fiscal buffers, have relatively low debt to GDP, and so do have some space to react. So, and I think, that this shock really shows how important that is, so that they, are relatively prepared to deal with this shock. That doesn't mean they don't need a lot of assistance. And a big concern of ours is how we can help the neighboring regions to Ukraine, but also the affected regions in Ukraine, both to either absorb the displaced people in terms of integrating them into the economy if things are to last, or to support those parts of Ukraine where already we're hearing that factories are back to work, etc. So we can ensure that the economies continue, and that the economic structure just isn't affected by this more than it needs to be if we didn't provide support for those firms and workers longer term. And I think, generally, globally, first of all, we have huge uncertainty, growing risks. Even within Europe, we see growing sovereign spreads. So this is very concerning, I think, in terms of the situation where you have high debt across sovereigns, corporates, households. So that's something that we're going to have to deal with. Of immediate issue, though, is this food price increase and how countries are going to deal with that. And we can see countries already have strong current account deficits, rely a lot on commodity imports or net commodity importers, and that they may have difficulties dealing with this in terms of the balance of payments. But importantly, also, we can see the correlation in the past between high food prices and energy prices and civil unrest, because of course it leads to huge poverty and huge problems for households just to, maintain not a high standard of living, but just a sufficient basket of goods to live a normal life. And we're already seeing that. So on the news, know what's happening in Peru. Remember the Arab Spring. So I think there are a lot of things we need to watch out for. Of course, we enter this after a period when there's been a huge amount of money spent on COVID support in our domestic economies, but that doesn't mean that we can neglect the support we need to provide emerging markets and developing countries to get through this period.
Actually, I follow what Emily just said, and unlike the COVID crisis, the war in Ukraine has a much more the impact is obviously has different strengths and force depending on the proximity to the war zone and also to the level of integration and trade and financial integration with the countries at war. So, and obviously countries with resilience, with buffers are going to cope more than those without. And Emily mentioned European countries. I can think of Turkey, that is a country with a critical debt situation, which is actually nearby the war zone and very much trade with Ukraine, both Ukraine and Russia. So that is a problem. Obviously, the situation will have an impact on growth, and that inevitably will impact on financial uncertainty, instability, and obviously the debt dynamics, inevitably. And again, as Emily said, the response to this crisis in many countries will go through the fiscal tools, because countries will have to support people who are struggling, income support or any kind of support to people, poor people, low-income households, then struggle with high food prices and high energy prices. So again, we will have an impact on the fiscal position on a number of countries, which might not be in a position to get more, increase their deficit and therefore increase their debt position.
Just answering your question, I don't have much to say about GDP-linked bonds or in that kind of engineering. I'll answer your question on sovereign concentration charges, which is very much a debate on banking union. I will just observe that the discussion on completing the banking union appears to be stuck. There's a lot of rhetorical lip service about completing the banking union and capital markets union. It's become almost an indispensable mantra when a politician makes a speech about strengthening the European Union. They say, and yes, we need to complete the banking union and the capital markets union, but we see very little action and very little political energy. As I said, we're in firefighting mode. So banking union in the halfway house condition where it currently is kind of works. There was, for example, a big success of the banking union framework, in my view, in terms of closing the European Union, Eurozone subsidiaries of the Russian banks in a very orderly way. When you look at what happened with Sberbank, with RCB in Cyprus, there was very good cooperation between the different pieces of the new framework, and particularly the European Central Bank, the SRB, and the relevant national authorities. So that has been successful. Having said that, I think we're all aware, or at least everybody in this debate is aware, that the current banking union is a halfway house. It doesn't reach the initially expressed objective of breaking the vicious circle between banks and sovereigns. And even so, of course, Next Generation EU has been a huge reassurance, because it has shown that when push comes to shove, there is willingness to share risk and pool fiscal resources and issuance and spending at the European level, which was a big game changer in terms of the general architecture. I think there are still very disturbing crisis scenario in which the bank sovereign vicious circle could come back. And we've seen that basically all the bank rescues that have required some expense of public money for good or bad reasons since 2012, the initiation of banking union, have been essentially funded by national resources, which means the bank sovereign vicious circle is alive and kicking. So the point you referred to, I think, is extremely important because there is a view that, concentrated sovereign exposures are not really part of that debate. Of course they are. They are a big part of the bank sovereign vicious circle to the same extent, to the exact same extent as national deposit insurance and national implicit guarantees of banks. So I think it is now evident after all these discussions and stalemates of the last few years that the completion of the banking union will not be achieved without bringing together the discussion on guarantees, deposit insurance, funding of bank crisis management and resolution on the one hand, and on the other hand, tackling the issue of concentrated domestic sovereign exposures, to which I still believe that the natural solution is sovereign concentration charges, at least as long as we don't have permanent and ongoing issuance of European bonds a la Next Generation EU. So I think this debate is still very current. It's not very urgent, which is why nothing is moving, but it will have to be tackled one day. Thank you.
Thank you again all very much for your comments. Etienne, may you have the floor.
Thank you, Angelos, and thank you everyone for first of all participating. Still quite a few online, and also for the panelists. I think it has been an extremely rich discussion. It's not the end for sure. We will come back to each other and we'll further discuss the issues that were presented in the report. I'd like to announce also that we are going to finish the Strasbourg session tomorrow, then go on Easter break, and then come back to have new events at EPRS. One of them will be on Thursday, to 21st of April. It's a policy roundtable on future shock 2022, linked to the discussions we had today, assessing EU risk and capabilities after Russia's war on Ukraine, or I would say during Russia's war on Ukraine, or in the context of Russia's war on Ukraine. And the following week, the 26th, a policy roundtable on the von der Leyen Commission at midterm stock taking in a global, in the context of a global turmoil. So I encourage you to register for this event and to join us. I wish you, thank you again, and I wish you a good rest of the day. Bye-bye. Thank you.